Welcome Home Radio Podcast. Are you looking to buy or sell your home? Our team is here with answers to guide you through the buying and selling process. We encourage you to ask questions. Please comment on this show or visit us at welcomehomeradio.net for more information. Bringing real estate, lending, and education together in one place, and to help you make the right home decision for you and your family.
Welcome to Welcome Home Radio, where real estate, lending, and learning come together. This is March 27th. Companies use credit scores to make decisions on whether to offer you a mortgage, a credit card, an auto loan, and other credit products, as well as for tenant screening and insurance. They are also used to determine the interest rate on credit cards, credit limits, and so forth. Credit is very important to our society nowadays, and for you to have a better lifestyle, for you to reach goals that you desire. Here today with us to talk about credit scores, and what you possibly can do about them is, of course, Jeff Duffee is with me from Fidelity Title, and our very good friend Nathan Biller from White & Jacobs. How you doing, guys?
Very good, thank you.
Hi, Blair. Thank you. Hi, Jeff. Nice to be here.
Good to see you.
Glad to see you here today. Thank y'all so much for joining us. Nathan, I heard you say you've been dramatically busy. The credit industry and repair, has it ramped up in this first quarter of the new year?
Yes, the number of people that are looking for homes has gone up, which always increases my business. The number of people that are, have some more viable economic situation has started to uptick slightly. And everyone always needs credit. So even when it's a downturn for us, we're still fairly busy.
Well, talk real quick about things that we can do. Talk about good credit habits, let's say. What would somebody that's trying to increase their scores, or at least have better scores, look for or need to do to make that happen for them?
Yeah, when I talk to individuals, a lot of times they're surprised by their credit scores being lower than what they would have assumed when they haven't looked in a while. And there's usually two reasons for that. The first one is they really just don't have enough open accounts. You have to have a bare minimum number of open revolving credit card or installment accounts, or both, to have some kind of score. Those can be open accounts or they could have been closed accounts, but it's necessary to have some kind of positive account information on your report, or either you don't have a score or it's not a score as high as you'd like it to be. The second reason why people typically have scores that are lower than what they would imagine is because there's a negative item of some kind that occurred 5, 6, 7 years ago that's still reporting, because all that information continues to report on your credit for up to 7 years, even if you've paid a balance off. So if you had a late payment on a credit card, that card's been closed for 3 years, but that late payment was within the last 7, it's still impacting your scores in a negative way. And if you only have 1 or 2 of those 1 or 2 accounts are still influencing your scores much more so than they would if they were removed or if they had fallen off due to the course of time.
What is the max points of something? Just say one bad trade line. How many points is somebody looking at?
100 to 150 points from one. If all you have is one negative and the rest are positive, that's the difference, depending on, some other factors. But it can be so significant, and you can see scores jump considerably once those things come off the report.
Wonderful. And you're available to help people. We see your phone number there. What's the company name again?
White Jacobs and Associates. That's my personal number. But, you can wait 7 years and anything will come off the report, but you don't have to, because there's a lot of opportunity to dispute or audit those accounts, and that's what we help do.
We have some wonderful ladies waiting in the room to ask some key questions. But before we do that, real quick, you said something that I want to clarify. Once a company is sold, let's say a medical bill is sold, and it goes to a factoring company, that 7 years may or may not matter, because that factoring company continues to do what? It stays on, and what are they doing to impact your score? Can you help our listener base to understand that, please?
Yeah, a factoring company or a collection company is an entity that purchases the debt from the original creditor and then reports it as a collection account. The problem is when they report that, they're reporting it as of the date that they made that sale, and the information about the original account whether that's 7 years old or not, is not provided a lot of times initially. And so even though legally they are not supposed to report information for accounts that are more than 7 years old, you'll see it all the time, because unless they're being held accountable, they're continuing to report debts that should automatically be removed. And a lot of times that's what we help people do as well.
Wonderful. I hope that comes in. We have some lady. Carol is going to join us here in a second. He has a couple of questions, or a question for us to answer. Carol, good morning. How are you?
Good morning. I'm great.
And Carol, help our audience know what you do. What is it you do?
Well, I'm a realtor for C221 Judge Fight Buying Homes and Estates, and I help people find their dream homes or to sell their home and move on to another place.
Well, thank you so much. And where could they contact you? What would be a phone number or an email?
I'll go ahead and give you my phone. It is 817-239-0509.
Wonderful. Wonderful. What is your question that you see your clients or friends asking about credit?
Okay, so what is the bottom score that we can have, and like what do we need? Obviously, besides contacting Nathan, what are some steps that they can start taking to improve their credit?
Nathan, do you want to take that, or you want me to?
Well, you can answer the part about what score that's required, and then I'll answer the rest.
Okay. Right now, FHA, we can do a loan as low as 580 for a score. 620 gets us into all the loan programs and down payment assistance that are out there. 580 is the minimum score we could use generally. Now, I can go down to 500, but it requires a large down payment and a large reserve base. But 580 would be that general score, and then 620 would be the optimal to allow us to use every loan program out there. Nathan?
And I would say the main thing that I tell people initially that they can do on their own is, if you have access to a credit report, or if you get one through myself or Blair or somewhere else, go through all of your open revolving accounts. That would be anything that's a retail card, anything that's a credit card, anything that's a line of credit, anything that shows a limit on an open account. That ratio is a huge part of your credit score. And if those accounts have balances that are very close to the limits, the scores will be significantly lower than if those are paid down. That's something that anyone can do and anyone can maintain. The only problem would be if someone assumes they're going to go in and pay all the debt off on their credit report, even though that doesn't necessarily hurt you. It's also maybe not the best and most efficient use of those funds, because there are certain accounts that if you pay them down or pay them off, you don't see benefit in your credit scores. So it's important to be strategic. And if you want to pay down open revolving credit cards, that's always fine. But anything else, it might be worth discussing as a consultation, whether that's worth a settlement or payment on those accounts.
Does that help?
Yes, very, very.
Carol, thank you so much for your time. I hope you have a great time out where you're vacationing, but I appreciate you taking a moment with us today.
You're welcome. Thank you. Have a good day.
Good question.
God bless. Hey, guys, one of the things I want to hit on and I want to make people aware of is something happened amazingly in September of 2023. And then it even grew in December of 2023, which is we surpassed the $1 trillion mark in credit card debt in September. We're at 1.7 trillion through the Christmas season. Nathan, what in the world do we see? I mean, this is unbelievable. This buy now, pay later mentality. I got to believe you're dealing with so much of this. Is that true? Or is that what you're seeing?
Yeah, 100%. I mean, it's been getting worse and worse gradually. And I think after the COVID period, it's just skyrocketed as far as the regularity of people being in severe debt, specifically credit card debt. And so what can you do about that? Obviously, if the funds are unlimited, you have the opportunity to pay those things down. But the problem is a lot of times people are over their heads and they can barely sometimes make minimum payments on these accounts. And so what's important to know is there is not a fix-all, catch-all that's going to take care of 100% of your credit card debt. Not only is there a negative impact to your credit, but there's obviously also financial repercussions as well. And so if you're in a position where you feel like you're underwater so much that you don't know where to turn, it's definitely more beneficial to speak with someone like myself or someone that is a credit expert, as opposed to someone that's only going to do debt consolidation, because a lot of times people going through debt consolidation end up in a worse position than they were originally. And the amount of money and time that takes may not be necessary if they're a little bit more strategic. Debt consolidation is a third-party company that's essentially forcing you to charge off and get all your accounts in a fully negative status so they have leverage to negotiate. That's not always the best answer, and it's certainly not the best answer for your credit, because your scores will plummet for a long period of time if you go through that process.
And I think, Blair, this is perfect opportunity to there's the difference of what separates Nathan compared to many other entities that offer to restore your credit. He worked with a law firm. And Nathan, stop me if you have the backbone that these groups pay attention and will more apt to listen to you coming from the company and the way that you'll handle things as opposed to other entities. I do know in the time I've known you, but there is a big, big difference on the results in that. I just want to jump in and add that real quick.
Yes, I completely agree. And the reason for that is because if you're in a position where you can still maintain good credit scores, there are ways to negotiate with creditors periods of deferred interest, periods of lower payments. Those are available to people outside of hiring a third-party company that's primary purpose is to ruin those accounts so that they'll gain some leverage in the negotiations. If those accounts have already gone to the point where they're negative and they're charged off and they're in a default status, we can also help reduce the amount of a settlement, if that's the desired result, by 50, 60, 70, 80%, which is even more so beneficial than what a typical debt consolidation company would be. So if somebody's telling you there's a one fix for everything, they're probably giving you less information than you need, and they're probably trying to sell you on something that may or may not be appropriate.
Can I also add in this moment that there is no certification in the credit repair industry? There is no one certified approval like we have as licensed realtors or licensed lenders that we go through. You don't have that. And I'm gonna tell you this out here right now. If the credit repair company that you're working with is not a law firm or any legal entity itself, they have no teeth. And Nathan, kind of explain that why here, especially in Texas, why that's so important because of what can happen with the Texas AG.
Yeah, I mean, there are some laws in place that are oftentimes avoided or broken by certain credit repair entities. I don't like to call us a credit repair company. I like to say credit restoration because it's a lot more of a comprehensive process. But the bottom line is I am FCRA certified, Fair Credit Reporting Act. I went through a class. You know, no one else that you talk to is going to be in that position typically at a credit repair. But even more importantly, we're licensed and bonded. You know, there's a legal entity that has to go through protocols to be able to take on clients. And we're licensed and bonded in several states. So it's just not the case that somebody you talk to from Facebook or TikTok or Google is going to have the same kind of approach and certifications. And the problem is most of my clients, honestly, have been through some kind of credit repair experience that was negative. And so they're very hesitant to begin with because they assume that every one of these companies is operating in the same manner. And I always tell people, unless they're having you sign a limited power of attorney form and an authorization to release information, what they're doing for you is exactly what you could do on your own or quite a bit less than that because they're charging you and not really doing everything that's possible.
Great word. Great word. Well, we have someone else. Precious is waiting in the back room. Precious, if you could join us, we'd love to hear your question. Good morning, Precious. How are you?
I'm great. And you guys?
Good.
Wonderful. Wonderful. Glad to have you here. Can you tell us where do you work? What do you specialize in? What that sort of thing for us?
I'm also with Century 21 Fine Homes and Estates here in Texas. I'm also licensed in Missouri as well. I'm with a smaller brokerage, more of a boutique brokerage called Worth Clark Realty. But yeah, I specialize in definitely helping first-time homeowners. A lot of my clients are first-time buyers, investors, and people looking to break into the investment world. One of the questions I think I come across the most is what form of credit lines can help build your credit the fastest?
That's a great question. Because there can be so many different variances. I think I have an answer to it, but Nathan, why don't you give us yours real quick?
Well, the truth is whatever's going to report to your credit is going to be beneficial. But you have to remember that some accounts don't report to all three credit bureaus. And so they're only going to help you on one or two. You have to make sure it's something that's reporting to all three bureaus. You have to make sure it's something you can get approved for. It'd be nice if you could just go apply for anything and get approved and build credit that way, but that's typically not the case. It takes credit to build credit. So you have to be applying for things that are credit builder type accounts if you're starting off. But the truth of the matter is, as long as the account's managed properly, you can get a benefit from a lower limit account the same way you can a higher limit account, at least initially. And what I'm focused on is 6 months or less. There's lots of things you can do long-term to build a robust profile, like adding a mortgage account or adding different types of accounts like installment accounts, revolving, et cetera. But in the short term, you just want to set up some kind of credit card. It could be a secured card or unsecured card. It's going to benefit you in a similar manner initially. And you want to have some kind of installment account without adding debt. Typically, I refer somebody to Self-Lender or Chime or something like that. But at the initial part of the process, you just want to get things you can get approved for and make sure your payments are made on time and make sure your balances are being managed properly. And then everything else you can build on that. But it doesn't matter if the account is, a $50,000 limit or a $5,000 limit. Both of those can help build your credit, even a $500 limit or $200 limit, as long as you're managing them properly.
Can I ask you to expand? You said something about reporting to the bureaus. Why is it so important? And what type of cards or other things are not reported to all three bureaus? And who would you want to use?
Yeah, so there's installment accounts are like car loans, bank loans, student loans. A lot of the car loans that are not with the larger finance companies will only report to one or two bureaus. And so the benefit and the negative only affects one. Credit cards, like something called kickoff lending, only reports to two bureaus, no matter what. There's other credit cards that only report to one bureau. So you just want to make sure whenever you're applying for something that it's going to report to all three if the purpose is to build your credit. Because when they do a mortgage pull, they're pulling all three bureaus. And even though they're only taking one of those scores as your middle score, if one of the scores is not available or if one of the scores is quite a bit lower, that really gives you a lot less leeway to try to have a maximum credit score. So it's important when you're applying that you ask these questions or try to go through the FAQs and determine if it reports to all three bureaus and if it reports at all. I have lots of clients that set up accounts, either car loans, credit cards, and they don't see it on their report because it's not an account that actually shows up on your credit.
Now, I'm going to share my golden nugget, and we're going to double check with our expert, Nathan, if this is a good way to do it. Nathan, what I did to build credit quickly for my children first time, I made them authorized users on my credit card without getting the card, but they were able to use my account history in their credit history. Is that a good way to do that?
Absolutely. And not everyone has the same wonderful father that you were, but if you have a friend or family member or anyone really that's willing to contact their bank and add you as an authorized user, it does not affect them at all. They don't even have to give you access to the account or the card, but it will show up on your credit report, and it should show up on all the bureaus that it's showing on their report. And that can benefit you even more so than a new account because you're getting the history. So if they've had an account since 2012 that's never been late, it looks like you've had an account from 2012 that's never been late. And then your credit can soar in a short period of time because you're getting the benefit. It's a loophole that if anyone can take advantage of, they should. There's also the downside, though. If that's an account that's been managed poorly or has a high balance, then it will affect you in a similar way.
Actually, my dad did the same thing for me. He gave me authorization once he bought me my first car. And it was basically like a gas card. It was like using when you need gas, but it was a card that he also used. So it definitely helped me in my early years.
Yeah, great question. And I think it's very viable for people to hear. If you're looking for a home, if you're looking for just starting off your credit, asking for help in that matter. My dad did it for me, but he never gave me.
Oh, did we lose you?
You're on mute, Jeff.
Yeah. And you
There
froze.
we go. Okay, sometimes this happens to Blair in his office. So while he catches back up, I will ask you a personal question that just happened to me 2 weeks ago. 2 years ago, we changed our insurance company, right? Mm-hmm. The old company we were with for 5 years called me back recently, and I wasn't thinking anything of it. Hey, Jeff, this is so-and-so. We haven't worked with you lately. I thought, okay, we liked them before. We know what, Blair, rates are gone up 27% on homeowners insurance coming up, they're saying. That's some projections at least. Yeah. But she said, hey, could we show you some numbers again? It's been a little while. I said, sure. Guess what? Without saying a word, she hit my credit. Yeah. Now, rumor, old wives' tales, do you have the ability to call them and say, I never gave you permission. You can remove that. You need to fix that. You need to please explain.
Well, the fine print of a lot of these applications includes their ability to pull credit at any point, even if you're no longer technically an active client. If they have that information, they can. Now, whether you could fight that in a court of law or not, sure. We go in and we audit these inquiries. We go in and work to try to get those removed using the Fair Credit Reporting Act. The impact of that is not as significant as a late payment or something else, but it can accumulate. And it's not really for our purposes whether it was legally allowed. It's them having to verify that they got the authorization and provide that to the credit bureau. So
just for learning purposes for everyone, that was purely verbal on the phone. That's why when it's quick and easy, I thought, yeah, I know you guys.
Yeah.
I wasn't a cold caller out of the blue, so
right.
I didn't think much of it. But she certainly never said, oh, by the way,
right,
we are going to run your credit. Never was mentioned, though.
Well, the thing people don't realize is everyone that you have an account with is doing that on a regular basis without you having any knowledge of it. And it's what it's called a soft inquiry, but they are still pulling your information on a constant basis to check whenever you're asking for a credit line increase, whenever you're asking for a new account, whenever they're just having conversations about the status of your existing account. So credit is being used more and more, and the visibility of that is becoming less and less for the consumer. And just like everything with technology that's going on with facial recognition and personal information, it's going to be more and more the case that whenever somebody's talking to you on the phone, they've got all the information about you and you're not even aware of it.
Thank you very much.
So because I didn't realize that the insurance, obviously when people are searching insurance rates when they're in the home buying process, I didn't realize that pulls credit lines. How many credit lines? So I always suggest my clients get inquiries in sets of 3. How many inquiries against you start to penalize you? Because if I'm telling you get, at least 3 lenders involved, that's 3 times they're pulling your credit. If I say get at least 3 insurance quotes, that's another 3. That's 6 inquiries within probably a 60-day period.
Well, the good thing is they give you leeway to apply for one specific type of account within a period of time between 7 and 14 days, depending on the account, with it only counting as one. So if you're going and getting 3 different mortgage inquiries in a short period of time, it doesn't impact you any more than one. But if those are spread out, they could be multiple inquiries. Each inquiry, like I said, is going to impact you 1 to 2 points per bureau. So it's not the end of the world. And obviously, the more you have, the less each one's impacting you. But it's certainly not the case that you want to just apply willy-nilly and not have any consideration about what you're doing, because those will add up. And if we're talking about 1 to 2 points and you've got 100 inquiries in a year, which, believe it or not, I've seen, that's definitely going to suppress the overall score that you show.
And how long does it take for inquiries to typically fall off?
It's 7 years. Well, that's not true. Most inquiries fall off in 2 years. They only affect you for 1, but they'll stay on your report for 2 years. And the initial year of that 2-year period is certainly the most impactful to your credit scores.
But let's clarify. You can have up to 10 mortgage, specific mortgage loan in 1 year, and it's not going to impact you as much as if it was a diverse group that you were looking for credit, because you have the right to shop for mortgages.
Right.
It will only affect you one time in a 30-day period, where if you were doing multiple car loans, credit cards, mortgages, blah, 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 that's going to impact you more. Is that correct?
Yeah, that leeway is per category. So if you're only doing mortgage applications for a short period of time, that only counts as one. But if you're doing credit card, car loan, bank card, a bunch of other things, that will add as separate inquiries, which means the scores will drop more quickly.
And the reason for that is that identification theft, stopping somebody from being able to get further credit on your name. That's really one of the key reasons. Is that right?
Yeah, I mean, the whole purpose behind this is they want to minimize risk. And when they see somebody that's applying for a bunch of things, that's risking it for a few different reasons. But the good thing to remember is anytime that I would recommend, or that somebody that knows what they're talking about would recommend you go apply for something, the net benefit of that account being on the report is going to outweigh any negative from the inquiry. And so it's important to only have those inquiries when you know that what you're adding is either necessary or beneficial for your credit.
Now, the final question I want to add in here is people do not understand. We talked about risk for rate, risk for insurance or car loan or not getting any credit, but also there is a risk for job performance and or job at all, because certain jobs require a certain score and certain promotions into management require certain scores to get promoted. Is that not also correct?
Yeah, I started with White Jacobs and Associates in 2014. And back then, the only times that I heard about a job requiring a certain credit score was usually some kind of government job or something that was specific to the industry. Now, large companies all over the place are requiring you to have a certain credit score or at least not defaulted accounts to get approved. And so I oftentimes now have clients that their main goal is to get approved for some kind of a promotion or just the application for a job itself. And so it's becoming more and more the case that your credit is impacting you in other ways with regards to opportunities professionally that weren't the case, 10, 15 years ago.
Well, Precious, I want to thank you so much for taking time today. We're so glad to have you on, and Carol, to ask your questions. I hope it was enjoyable time and informative.
It was. I enjoyed it. Oh, can I plug my number as well? I know Carol said her phone number.
Go right ahead.
I still have my Missouri area code, so it's 314-456-1093 if anyone needs to contact me.
Wonderful. Well, thank you again for being here. Nathan, thank you for your time today, as well as Jeff. Appreciate you always being here, brother. I have some final thoughts on credit. What you can do about them is twofold or multiple fold. Pay your commitments. Pay them off as quickly as you can. Never, ever, ever pay minimums. Please don't do that. And then challenge and or dispute trade lines that may not be yours. And finally, monitor your credit. You get 3 credit reports per year, 1 pure bureau. Please take them once every 4 months. Don't take them all at once, so that you can track and see your credit. And finally, if you are not going to be using your credit, you can freeze your credit so that it will not be stolen or utilized in any other stance without your permission. I'm Blair Thomas with welcomehomeradio.net. I am so thankful for everyone. God bless, and we'll see you next month.
Have a great day.
Thank you.
Welcome Home Radio Podcast. Are you looking to buy or sell your home? Our team is here with answers to guide you through the buying and selling process. We encourage you to ask questions. Please comment on this show or visit us at welcomehomeradio.net for more information. Bringing real estate, lending, and education together in one place, and to help you make the right home decision for you and your family.